At 6 a.m. Eastern Time this morning, Monday, April 20th, 2026, silver gapped down from $80.50 to $79.20 in the first 60 seconds of trading. By 6:15 a.m., it touched $70.94. That is a $1.56 drop in 15 minutes on volume that was 4 times the normal opening range. And I want to be absolutely clear about something before we go any further. That was not natural price discovery. That was not organic market reaction to the USS Spruance incident or the Iran ceasefire collapse. That was a designed, pre-programmed, algorithmically executed shakeout engineered by institutions with billions of dollars at risk in the next 8 trading days. This is not conspiracy theory. This is market mechanics that have been documented, prosecuted, and settled in federal court. And tonight, I'm going to show you the exact fingerprints of manipulation, who profits when you panic sell, and why this morning's gap down is the last desperate move before silver breaks free. Let me start with the Commitment of Traders report, because this is the single most important data set that reveals exactly who is positioned on which side of this market. The QT report is published every Friday by the Commodity Futures Trading Commission. It breaks down futures market positions into 3 categories: commercial traders, large speculators, and small speculators. Commercial traders are the banks, the bullion dealers, the institutional players. Large speculators are hedge funds and commodity trading advisors. Small speculators are retail investors like you. The most recent COT data, as of April 14th, 2026, shows commercial traders holding a net short position in silver of approximately 58,000 contracts. That represents 290 million ounces of paper silver that commercials have sold but do not physically hold. These are the entities that benefit when silver prices fall because they are betting against the market. Now, here is the critical detail. That 58,000 contract commercial short position is down from a peak of 82,000 contracts in early March when silver was trading near $90. Between March and now, commercials have covered approximately 24,000 contracts. That is 120 million ounces of short covering. When a commercial short covers, they have to buy back the contract they sold. That buying drives prices up. Silver's move from the March 23rd low of $61.76 to Friday's close near $80 was partially fueled by that short covering. But here's the problem for the shorts. They still have 58,000 contracts, 290 million ounces that they are short. And with May 1st notice day 8 business days away, those positions are at maximum risk. If silver continues climbing and breaks above $85, those commercial shorts face massive margin calls. Every dollar silver rises costs them $290 million in mark-to-market losses. That is the incentive structure that explains this morning's gap down. The commercials need silver lower, fast, before delivery pressure makes their positions untenable. Now, let me show you the pattern of margin hikes and price crashes that proves this manipulation is systematic, not random. On February the 2nd, 2026, the CME Group raised initial margin for silver futures from 10% to 15%. The announcement came on a Sunday evening after markets closed. When silver reopened Monday morning, it crashed from Friday's close of $118.45 to an intraday low of $71.22. That is a 39.8% collapse in hours. Now look at the timeline. Silver had hit its all-time high of $121.67 on January 29th. The margin hike was announced February 2nd, just 4 days later. CME claimed the increase was necessary due to increased volatility. But here is what they did not say. The margin hike forced every leveraged long position to either deposit more capital immediately or be liquidated by their broker. Thousands of retail accounts were wiped out in a single session. Who bought the dip at $71? The same commercial traders who were massively short at $121. They covered their shorts at $71, pocketing $50 per ounce, and then went long. By the time silver recovered to $80, those commercials had flipped from short to long and captured the entire round trip. This is not the first time. On March 24th, 1980, CME raised silver margins from $6,000 to $100,000 per contract in a single day. Silver crashed from $35 to $10, $80 within weeks. The Hunt brothers, who were trying to corner the market, were bankrupted. But the commercial shorts, who had been underwater at $49 silver, survived and profited. The pattern is consistent. Massive rally, emergency margin hike. Retail liquidation, commercial accumulation. Repeat. This morning's gap down at 6 a.m. is the same playbook, just without the margin hike yet. But I would not be surprised to see CME announce another increase in the next 72 hours if silver tries to reclaim $82. Let me explain the stop-loss hunting mechanism that makes gap downs so effective at transferring wealth from retail to institutions. When retail investors buy silver, most place stop-loss orders to protect against downside risk. A stop-loss is an order that automatically sells your position if price falls to a certain level. If you bought silver at $78 and you set a stop loss at $76, your position automatically sells if price touches $76. Stop loss orders are visible to market makers, not individually, but in aggregate. Market makers can see clusters of stop loss orders sitting just below current prices. On Friday, April 18th, silver closed near $80. Technical analysis suggested major support at $79, then $78, then $76, or $50. That means large clusters of retail stop losses were sitting at $78, $95, $78.50, and $76, $50. This morning's gap down to $78.94 was not random. It was precisely calibrated to hit the $79 stop loss cluster, trigger automatic selling, create panic, and drive price lower into the next cluster at $78.50. By 6:15 a.m., price had touched $78.04, swept all the stops at $79 and bounced. Who bought at $78.94? The same entities that sold at $81.50 to create the gap. They sold high, triggered your stop loss, bought your silver at $78.94, and pocketed 1.56 per ounce of your money. This is not illegal. It is how institutional players extract profit from predictable retail behavior, and it happens every single time a major support level is approached. Here is the options market data that reveals the exact price levels institutions are defending. The COMEX silver options market allows traders to buy calls or puts at specific strike prices. A call option gives you the right to buy silver at a set price. A put option gives you the right to sell at a set price. The open interest at each strike price tells you where the big money is positioned. As of Friday, April 18th close, there were 12,847 call options with a strike price of $85 expiring in May. Each option represents one futures contract, which is 5,000 ounces. That is 64.2 million ounces of call options at the $85 strike. If silver closes above $85 when those options expire, the sellers of those calls, the entities that are short those options, have to deliver 64.2 million ounces, or pay the cash equivalent. That creates massive losses for the short side. The largest institutional options, sellers, JP Morgan, Citigroup, Bank of America, have an enormous financial incentive to keep silver below $85 through May options expiry. Every dollar silver stays below that strike price is a dollar they keep from option premiums they collected when they sold those calls. This morning's gap down from $80.50 to $78.94 increased the distance between current price and the $85 strike. That reduces the probability that those calls expire in the money. The option sellers benefit. The retail call buyers lose premium value. Wealth transfer complete. Now let me show you the physical market data that proves paper and physical are completely disconnected, because this is the crack in the manipulation structure. Right now, Monday, April 20th, 2026, APMEX is selling American Silver Eagles for $88.49 per ounce. The COMEX paper price is $79.31. That is a $9.18 premium. In Canada, silver maples are $106 per ounce, which converts to approximately 83.45 USD at today's exchange rate of 1.39. That is a $4.14 premium. These are not outlier data points. SD Bullion shows $85.99 for generic rounds. JM Bullion shows $86.49 for Eagles. Monument Metals shows $84.99. Every major dealer in North America is transacting physical silver at $84 to $89, while the paper market shows $79.31. The premium is the market telling you that $79.31 is fiction. The real clearing price, where actual metal changes hands, is $6 to $9 higher. And here is why that matters for the manipulation thesis. The entities that are short paper silver at $79 cannot deliver physical silver at $79 because physical does not trade at $79. It trades at $86. If significant delivery demand arrives at COMEX in the next 8 days, those shorts will have to source physical metal at $84 to $86 to fulfill contracts they sold at $79. That is a $5 to $7 per ounce loss on every contract they have to deliver. Multiply that by 290 million ounces of commercial short interest. That is $1.45 to $2.03 billion in losses. That is why they need the shakeout. That's why they gapped it down this morning. They are trying to scare enough longs out of their positions that delivery demand stays below the threshold that forces them to buy physical at a loss. Here's the volume analysis from this morning's open that shows the gap down was institutional, not retail. In the first 15 minutes of trading, 41 million ounces of paper silver traded. The average daily volume for silver futures is approximately 180 million ounces across the entire 23-hour trading session. That means 22.7% of a full day's volume traded in the first 0.98% of the trading day. Volume that concentrated in that short a time window cannot be retail. Retail investors do not have the capital or the coordination to move 41 million ounces in 15 minutes. That is institutional block selling. Computer algorithms executing pre-programmed trades the instant the market opened. Now look at what happened after the gap down. From 6:15 a.m., when price bottomed at $78.94 to 9 a.m., when the New York session fully opened, silver climbed back to $79.67. A 73-cent recovery in 2 hours and 45 minutes on volume that was 1/3 the volume of the opening 15 minutes. Light volume recovery after heavy volume decline is the signature of a bear trap. Institutions sell heavy to gap it down. Retail panics and sells into the decline. Institutions then buy back slowly on light volume, accumulating the shares retail just sold at a discount. By midday, institutions are net long at lower prices, and retail is sitting in cash, locked out of the recovery. Let me give you the historical pattern analysis that shows every major silver bull market was preceded by a final shakeout that looked catastrophic at the time. In 1979, silver traded in a range between $6 and $9 for most of the year. In September 1979, it crashed from $17.50 to $10.40 in 3 weeks. Every analyst called the rally over, retail sold. Then from November 1979 to January 1980, silver went from $10.40 to $49.45, a 375% gain in 10 weeks. The people who sold at $10.40 missed the entire move. In 2010, silver spent the summer consolidating between $17 and $20. In August 2010, it dropped to $16.50, and analysts called for $14. Retail sold. From September 2010 to April 2011, silver went from $16.50 to $48.70, a 195% gain in 7 months. In 2020, silver crashed to $11.77 in March as the pandemic hit. Every commentator said it was going to $8. Retail panic sold. From March 2020 to August 2020, silver went from $11.77 to $29.35, a 149% gain in 5 months. The pattern is always the same. A sharp, sudden, terrifying drop that breaks retail psychology, maximum fear, maximum capitulation, maximum selling, and then the largest gains happen in the months immediately following that capitulation point. This morning's gap down from $80.50 to $78.94 is this cycle's capitulation event, and the investors who recognize it for what it is and buy instead of sell are the ones who capture the next leg up. Now let me explain the dollar correlation that institutions are exploiting to suppress silver while strengthening the dollar. The U.S. dollar index opened Monday at 98.31, up 0.21% from Friday's close. When the dollar rises, commodities priced in dollars become more expensive for international buyers. That reduces demand and pressures prices lower. But here is what most analysts miss. The dollar rally this morning was not driven by dollar strength. It was driven by risk-off flows as stock futures crashed on the Iran news. Dow futures fell 407 points. S&P futures dropped to 0.67%. When stocks fall, institutional portfolios automatically rebalance into cash, which means buying dollars. That automatic rebalancing creates a temporary dollar rally that has nothing to do with the fundamental value of the dollar. The U.S. is running a $2 trillion annual deficit. The national debt just crossed $39 trillion. The IMF has flagged U.S. debt as a global systemic risk. None of those fundamentals changed overnight. But the dollar rallied anyway on technical flows. Institutions know this. So they time their silver selling to coincide with automatic dollar strength from equity market sell-offs. The dollar rally provides cover for the silver decline. Retail investors see dollar up, silver down, and think it is normal correlation. They do not realize the dollar rally is temporary and technical, while the silver selling is deliberate and targeted. When stocks stabilize and the risk-off dollar bid fades, silver will recover. But the retail investors who sold at $78.94 will not participate in that recovery because they have already been shaken out. Here is the open interest data that shows the shakeout is working exactly as designed. On Friday, April 18th, total COMEX silver open interest stood at approximately 575 million ounces. By Monday, April 20th, midday, open interest had fallen to approximately 568 million ounces. That is a decline of 7 million ounces, or 400 contracts in one weekend. Open interest declines when traders close positions. The 1,400 contracts that closed were not institutions covering shorts. Commercial short interest is still near 58,000 contracts. The contracts that closed were retail longs who got scared by the weekend war news and exited their positions Sunday night or Monday morning. That is exactly what the shakeout was designed to accomplish. Scare retail out of long positions, reduce open interest, reduce potential delivery demand, and give commercials breathing room as May 1st notice day approaches. The institutions that are short do not need silver to crash to $60. They just need enough retail longs to exit that delivery demand stays manageable. This morning's gap down accomplished that objective. When 400 contracts closed, 7 million ounces of potential delivery demand eliminated. Let me show you the technical setup that makes 78 out of 94 the line in the sand for this entire manipulation strategy. On the daily chart, silver has been forming a bull flag pattern since the April 7th low of $72.88. A bull flag is a consolidation pattern that typically resolves to the upside. The flagpole is the sharp rally from $72.88 to $80.33. The flag is the sideways consolidation between $78 and $81 over the last week. The lower boundary of that flag sits at $78.50. This morning's low of $78.94 tested that boundary and held. If price had broken below $70.50, the technical pattern would have failed, triggering additional algorithmic selling and likely taking silver down to the next support at $76.50. But it did not break. It touched $78.94 and bounced. That bounce confirms the bull flag is still intact, and if the flag resolves to the upside as the pattern suggests, the measured move projects a target of $87.45. Here's why this matters. The institutions that gapped silver down this morning were not trying to crash it to $60. They were trying to break the bull flag, trigger a technical failure, and create a cascade of stop-loss selling. The fact that support held at $78.94 means the shakeout failed. The technical pattern survived, and the next move is likely to the upside. Here is the China data that confirms the physical market is completely ignoring the paper shakeout. China's Shanghai Gold Exchange showed silver trading at a 12.8% premium over COMEX as of Monday morning, April 20th. At a COMEX price of $79.31, that premium equals approximately $10.15 per ounce. Shanghai physical silver is trading at $89.46. That premium has been persistent for 6 weeks. It is not narrowing, it is widening. On March 15th, the Shanghai premium was 9.2%. On April 1st, it was 11.1%. On April 15th, it was 12.3%. Today, it is 12.8%. A widening premium means Chinese buyers are willing to pay more and more above the COMEX price to secure physical metal. That is the opposite of what should happen if the paper market accurately reflected supply and demand. If silver were truly in surplus, or if demand were falling, the premium would narrow or disappear. The widening premium proves that the paper market is disconnected from physical reality. And every day that disconnect persists, the probability increases that the paper price eventually snaps upward to close the gap. Here is the final piece that reveals why this shakeout is the last desperate move before the system breaks. 8 business days until May 1st notice day. 47,034 contracts still open. 235.2 million ounces of claims against 76.88 million ounces of metal. The commercials that are short 290 million ounces have 8 days to reduce that exposure before delivery notices start arriving. They cannot cover 290 million ounces in 8 days without driving the price vertical, so they have to reduce delivery demand by scaring longs into closing positions. This morning's gap down was move 1. If it does not work, expect more. Margin hikes, rumors of emergency COMEX rules, coordinated media headlines about silver oversupply. Every tool in the manipulation playbook will be used in the next 8 days, because the alternative is a delivery failure that exposes the paper market as a fraud. But here is the thing about shakeouts. They only work if you let them. If you understand that the gap down to $78.94 was institutional fear, not market reality, you do not sell, you hold, or you buy more. Because on the other side of this 8-day gauntlet, silver is either going to $90 or the COMEX is going to implement emergency measures that prove everything we just discussed was real. Either outcome is bullish for anyone who held. Monday, April 20th, 2026. Silver gap down from $80.50 to $78.94 in 60 seconds. 41 million ounces traded in 15 minutes. Retail stop losses were swept. Open interest dropped by 1,400 contracts. The shakeout worked on some people, but the 76.88 million ounces in registered vaults did not increase. The 235.2 million ounces of May claims did not decrease. The 12.8% Shanghai premium did not disappear. The 6-year structural deficit did not reverse. The gap down was designed to shake you out. The question is whether you let it. This is Stacker Intelligence. Do your own research. This is not financial advice. Do not let a 15-minute algorithm undo a 15-year thesis.